The buying trends we saw and how much of it is what we put down to yesterday's gains at the back of, end of quarter sort of positioning?
James, once again, a very similar trend to what we saw yesterday, and that is the Australian market outperforming the region, divergence from the performance with the Aussie dollar, and once again strength in our market despite offshore leads. If we have a look at our market, only down by 0.1% despite the US market being down by 0.5% and the London FTSE off by even more than that overnight. So it does look like there is quite a bit of end of quarter activity going on where the Australian market has lost 7%. We know that a lot of money managers are underweight equities, and with the positive performance probably scrambling to change asset allocation before the quarter end. This is also seen in the small ordinaries index, which has underperformed. We are seeing most of the interest in the large cap stocks and good volumes going through the market today at the moment. Probably not surprising seeing that it is single stock expiry, so we will see some good volumes going through the market tomorrow morning with the expiration and the exercise of a lot of those option contracts as well. But altogether, if we have a look at the market, really just shrugging off a lot of what happened offshore. Though the energy sector, though the worst performing sector, with oil prices taking a bit of a tumble. The US inventory data was a surprise. We actually saw crude stockpiles 3 times the expected amount last week, and of course with France talking about supporting the release of strategic reserves, that energy sector coming under a bit of pressure today. But altogether, the Australian market once again putting in a pretty impressive performance.
The upside in the bank share prices in the absence, as Michael said, of the concerns that seem to dominate investor thinking, particularly in regards to Europe?
I think Rick has hit on a very important point, and that's the expectations around interest rates here in Australia and the impact it has on the Aussie dollar, helping not only the banking space, but of course Australia's very much an exporting nation as well, so helping a lot of those companies with exposure to offshore earnings. So if we have a look at that low Aussie dollar, it's really given stocks like QBE Insurance, Computer Share, CSL, Amcor all a boost, and we are seeing some sort of support from that weaker Aussie dollar flowing through as well. So lower interest rates would be a positive because it would have an impact in terms of the currency and in terms of positive impact on the Australian market. And of course the other one that we're watching is China. While Australia has very attractive valuations, the Chinese market has even more attractive valuations as well. So one thing that could get the Aussie market moving very quickly is some positive momentum coming through from China. But of course the last couple of sessions we've seen the Chinese market really weighing in terms of offshore market performance and sentiment, because we've seen the Shanghai Composite down 2.7% yesterday and down another 0.6%.
Then they are more and more becoming an iron ore producer, a pure play almost, with about 73% of their earnings coming from iron ore. Where is that going to leave them in terms of an investment attractiveness come 2015 or so?
James, all the signals are that the market's not satisfied with the strategy coming through from BHP or Rio, and instead going to more of a single commodity producer like Fortescue. And the last quarterly performance has really reflected that view, with BHP down by 1%. Rio Tinto has managed a gain of 6%, pretty much in line with the market. But Fortescue has absolutely steamrolled ahead, up by a massive 39%. And if we have a look at, I guess, the big miners and what the market's thinking is, it's really quite difficult to I guess it's a bit of a tug-of-war between the medium-term story and the long-term story, and Blackrock's move overnight really reflects that. It's looking at an investment time frame of 2 to 3 years, but we're seeing these big miners, BHP and Rio, really investing for the next decade. So a massive amount of capital expenditure in terms of BHP's case is looking to ramp up iron ore production from 175 million tonnes per annum and doubling that to 350 million tonnes per annum by 2020. So looking at these huge longer range plans more over a decade rather than the 2 to 3 year time frame that a lot of fund managers and investors are looking at in this type of environment. So I guess BHP, Rio Tinto, a case in point where just because the stock is looking very cheap doesn't mean that we're going to see some sort of catalyst anytime soon to really turn around the share price, because while the stock's looking cheap now, it was still looking cheap 6 months ago, and it was still looking cheap a year ago. In fact, in terms of every single value metric that you have out there, both BHP, Billiton and Rio Tinto are looking cheap. In fact, return on equity, return on invested capital looking very strong. In terms of gearing, very moderately geared and very conservatively geared. But if you have a look at the share price, it tells you a very different story. And what these stocks don't have at the moment is positive momentum. It's negative momentum which is involved in the share price. This is BHP Billiton over the last year, brokers have had a buy recommendation all throughout the last year, saying the stock is cheap, and it's just gotten even cheaper. You can see that we're at a vital point at the moment. We're at a very important support level at the $34 mark. So we'll have to see whether we once again see a bounce off this mark. But if we see a break of that $34 mark, it certainly bodes for some more technical weakness ahead. But this is a stock which is extremely strong return on equity, strong return on invested capital, looking extremely cheap on every single metric. But in terms of share price performance, it just hasn't been there. And the market's really been playing tug-of-war with that medium-term story versus a long-term story. Yes, the long-term story is intact, but most investments are looking at a shorter time frame in this type of market environment especially.